Your money-making broadcast starts now. Good evening. Today is June 5th, Friday. Here are the top stories moving the markets. We are witnessing a critical structural shift as the S&P 500 officially enters a bear market regime today. With the VIX surging for 5 consecutive days and mega-cap tech stocks bleeding heavily, investors are scrambling for safety. We will analyze why the current risk-off sentiment is accelerating, the specific technical breakdowns in the Mag 7, and where the hidden opportunities lie in this new volatility. We will dive deep into the JAVAS HMM regime detection data to understand the historical probability of recovery and the precise RSI levels that signal a potential bottom. In an environment where volatility is the only constant, understanding the shift from momentum to mean reversion is the difference between capital preservation and catastrophic loss. We will also examine the macro divergence between cooling inflation and falling equity prices to determine if we are facing a standard correction or a systemic crisis. Before we dive into the big stories, let's look at the closing numbers. The S&P 500 ended the session at approximately 7,500, down 0.4% today and 2.5% over the last 5 days. The Nasdaq took a harder hit, closing at 26,000, down 1% on the day and 4.5% for the week. The Dow Jones Industrial Average showed some relative resilience, closing at 50,000, up slightly by 0.1%, though it remains down 0.2% over the week. The Russell 2000 continues to struggle, down 3% over the 5-day period. In the volatility space, the VIX has surged to 21.51, marking its 5th consecutive day of gains. In other assets, the 10-year Treasury yield sits at 4.47%, while gold has seen a sharp decline, with GLD down 5% over the week to $396.24. Bitcoin remains highly volatile as the risk-off sentiment spreads through the digital asset space. Big Story 1, the bear regime arrival and the VIX alarm. Today marks a pivotal moment for global investors as the JAVAS HMM regime detection system has officially signaled the start of a bear market regime. This is not just a minor dip, we are entering a phase where the average daily return historically drops to negative 1.100%. To put this in perspective, bear regimes have only occurred in about 1.5% of the last 10 years of S&P 500 history, making this a rare and dangerous environment. The most alarming signal is the VIX, the market's fear gauge, which has skyrocketed from 15.32 to 21.51 over the last 5 days, a massive 40% increase. This structural rise in volatility suggests that institutional players are hedging aggressively. JAVAS analysis indicates we are in the early stages of a reflexive loop where rising fear leads to more selling, which in turn fuels further volatility. For the savvy investor, the strategy must shift immediately from momentum to RSI mean reversion. This means we stop chasing breakouts and start looking for extreme oversold conditions. The data shows the S&P 500 is currently hovering around 7,500, down 2.5% over the week, while the Nasdaq has been hit even harder, sliding 4.5% to approximately 26,000. The surge in QQQ trading volume, hitting 90 million shares compared to the 41 million average, confirms that big money is exiting growth positions. In this environment, capital preservation is the only priority. As legendary trader Paul Tudor Jones suggests, we must listen to what the price action is telling us, and right now, the price action is screaming risk off. We must consider the psychological impact of this shift. When the retail crowd finally realizes the trend has changed, the selling pressure often intensifies, creating a vacuum effect in liquidity. JAVAS suggests that until the VIX stabilizes or shows a rounding bottom pattern, any bounce should be viewed as a relief rally rather than a trend reversal. Big Story 2, Megacap Tech Meltdown and the Technical Warning Signs. The bleeding in the technology sector is becoming systemic. We are seeing a series of devastating chart patterns across the Mag 7. Amazon has collapsed 9.1% over the last 5 days, forming a classic double top at $275 and $274, with its RSI dropping to a precarious 36. Meta is not far behind, down 6.2% with a double top at $618 and $635. Most concerning is the risk profile of Meta, where the Sharpe ratio has plummeted to negative 0.37, the only negative in our core tracking list, meaning the volatility is no longer being compensated by returns. Apple has also entered a danger zone, down 6.8% over the week. It has formed a head and shoulders top, and the critical neckline is at $182. If Apple breaks below $182, we are looking at a structural correction rather than a temporary pullback. Even Nvidia, the darling of the AI era, is showing weakness with a head and shoulders top at $195 and an RSI of 34, signaling it is approaching oversold territory. This synchronized decline in the largest companies in the world suggests a rotation out of growth and into cash or defensive assets. Javas warns that the VaR 99 for Meta is now negative 7.96%, indicating a high probability of severe tail risk events. When the leaders of the market lose their technical support levels simultaneously, the broader index cannot hold, regardless of the fundamental narrative. We are seeing a breakdown in the correlation between AI hype and actual price action. The market is now discounting the future earnings of these giants, pricing in a slower adoption curve or a macroeconomic headwind that outweighs the technological advantage. This is a classic derating phase where multiples contract sharply. Big Story 3, Macro Divergence and the Fed's Tightrope. Despite the equity carnage, the macroeconomic backdrop presents a confusing divergence. On one hand, we have inflation cooling, with expected inflation dropping 7.8% over the year to 2.48%. The federal funds rate has also decreased by 16.2% annually to 3.63%. Normally, falling rates and cooling inflation are bullish for stocks. However, the market is currently ignoring these positives and focusing on the risk of a growth slowdown. Gold, which usually serves as a hedge, has surprisingly dropped 5% over the last 5 days, with GLD hitting a 52-week low near its support. This is a classic sign of a liquidity squeeze. When the market panics, investors sell everything, including gold, to cover margins in their equity portfolios. The 10-year Treasury yield is at 4.47%, and while it has dropped 3% over the year, the recent volatility in the VIX suggests that the market is no longer betting on a soft landing. We are seeing a shift toward a regime where the risk of recession outweighs the benefit of lower rates. Javas notes that the Finbert sentiment analysis still shows a slight positive bias of 16%, but the 18 detected crisis keywords are a red flag. This gap between positive news sentiment and negative price action is a textbook example of a market top transitioning into a bear phase. Investors should remain cautious as the market recalibrates its expectations for the second half of 2026. The divergence between the bond market and the equity market is particularly telling. While bonds are pricing in a slowdown, equities are reacting with panic, suggesting that the insurance of lower rates is not enough to offset the fear of declining corporate earnings. This is a precarious tightrope for the Fed, as they must balance inflation targets with the need to prevent a systemic financial collapse. Looking at the portfolio implications, the Javas system currently maintains a 65% cash position, which aligns perfectly with Druckenmiller capital preservation strategy. The most concerning holdings are CRM at $185.66, down 6.7% and approaching the hard stop loss at 8%, and Apple at $178.45, down 5.7% with a head and shoulders neckline at $182. Under Munger worst-case scenario analysis, a further 10% decline in CRM would only impact the portfolio by 2.3%, demonstrating that the current position sizing is appropriate for risk management. Meanwhile, Cisco remains the portfolio star with a 27.2% gain, and a partial 50% sell is under consideration to lock in profits. The focus now is on reducing beta and increasing the quality of the remaining holdings. We are prioritizing companies with strong free cash flow and low debt-to-equity ratios to weather the storm. Looking ahead to next week, the key events to monitor include the VIX direction on Sunday evening futures, CRM ability to hold the $180 support level, and Apple $180 psychological barrier. The Javas system identified Amazon with RSI of 32 in deep oversold territory and a positive alpha of 1.150% in shadow paper testing, making it a prime candidate for re-entry once the VIX stabilizes below 16. Similarly, JP Morgan Chase showed 1.267% positive alpha, positioning both as quality names for the eventual recovery. We will be watching the 200-day moving average of the S&P 500 closely. If it fails to hold, the next support level is significantly lower, potentially triggering another wave of algorithmic selling. A key principle to remember: listen to what the price action is telling you. Currently, the VIX trajectory and the synchronized decline in megacap tech are telling us to remain defensive. Cash is a position, and patience is a strategy in this bear market environment. Do not let the fear of missing out on a bounce lead you into a premature long position. The trend is your friend, and right now, the trend is downward. To wrap up today's session, the overarching theme is a transition from optimism to preservation. We have officially entered a bear regime, signaled by a 40% spike in the VIX and a systemic breakdown in megacap tech patterns. The key is to maintain a high cash position and wait for RSI-based mean reversion opportunities rather than fighting the trend. Now, let's look at the Javas recommended lineup for this volatile environment. First, for those seeking a safe haven, the father of modern value investing, Benjamin Graham, would choose the Invesco S&P 500 Low Volatility ETF, SPLV, at $72.45. This pick is based on the need for a safety margin during bear regime day one, focusing on stocks with the lowest historical volatility to protect capital while the rest of the market corrects. For a balanced approach, the legendary Wall Street manager Peter Lynch would choose JP Morgan Chase, JPM. This company carries a positive alpha of 1.267% in shadow paper testing, making it a balanced pick that combines dividend stability with value-oriented resilience in this volatile market. For those chasing high-growth innovation, the world's leading innovative fund manager Cathie Wood would choose Palantir Technologies, PLTR, at $24.12. In a volatile market, pure-play AI data integration remains a structural growth story, and PLTR's ability to maintain institutional demand during a broad sell-off makes it a prime candidate for a recovery bounce. Finally, for a low-cost, contrarian play, the master of global investing John Templeton would choose the iShares 20-plus-year Treasury Bond ETF, TLT, at $91.20. With the market entering a bear phase and a potential flight to safety, this fund provides an inverse correlation to equity risk and benefits from the long-term trend of falling interest rates. Subscribe to stay ahead of the markets every single day. We break down the data so you don't have to. Check our shorts for a 60-second highlight. That's all for today. We all become wealthy together.